Hi, in this module, we are going to talk about the 10 steps to protect your seller in a finance transaction. Nobody likes a surprise when it comes to a real estate transaction, especially when you're on the listing side and you're not going to be privy to everything that's going on with the buyer's financing. Now, if they're paying cash, obviously that's a much easier situation because you're not waiting for an approval. But waiting for that approval, especially when it comes down to the wire, where you're waiting for the closing documents to get the title, it can be stressful, especially if it's a domino transaction where your seller needs to sell their property so that they can then buy another property and that person can buy a property and everybody's got moving trucks ready to go. And then all of a sudden you find out, oh, by the way, the buyer's not closing. Nobody wants to go through that. So in this webinar, what we're going to try to do is try to get an idea of what can you do, what is within your power to try to find out what is going on with the financing to make sure that they're on target. Now, obviously, there's privacy issues, and every state is going to be a little bit different in its procedure, but you've got the federal laws, so it's not as if the lender's going to be able to share a lot of information about the financing as far as the individual getting the financing and stuff like that. But there's other ways that you can find out and get a good idea of where you're at with this approval and whether or not there's a problem. So the real big point here is to try to reduce the possibility of a surprise, even though it's not going to be 100% all the time. So obviously when you're the listing agent, you don't have a lot of control over whether or not that buyer is going to get their financing. You get a pre-approval letter, you're assuming that this buyer is qualified, that the lender who has put their name on this pre-approval form, whether it's a pre-qualification form, a pre-approval form, conditional loan approval, whatever your state calls that form, if they have an official form, or it could just be something that the lender provides, no matter what that is, you're taking the word of that lender that this buyer is going to be able to get their actual financing. But those pre-approvals, as you probably maybe have even experienced, but as you know, they're not necessarily worth anything, not even worth the paper they're printed on, because of the fact that so many times somebody will get a pre-approval, but then they're never approved. And if they're not going to get approved, obviously you want them to be denied as quickly as possible. Now, in an ideal world, the ideal situation would be this. The buyer would go to the lender, get their file underwritten so that they've already got a credit and income underwrite, so that they don't have any conditions other than an appraisal, a preliminary title report, and of course an executed contract and a close of escrow date. Some lenders will do that and some won't. So if you're in that situation where somebody has already been underwritten, I'd say you're in the best possible situation. However, even in that circumstance, which is probably the most ideal other than a cash buyer, you can still have surprises. People get laid off, people get fired from their jobs. Keep in mind that employment still has to be checked at closing. The guideline is going to be 10 days prior to funding. That verification of employment needs to take place. So a lot of times the verification of employment is taking place 2 times, once at the beginning and then again at the end. If something has changed on their credit, if they have gotten new credit that the lender didn't know about, something like that, there's always the possibility of that happening regardless of the fact that they've already been approved. I'm talking fully approved. So there's a big difference between being pre-approved based on some numbers. So you want to ask the question of, have you looked at the documents? Has the underwriter looked at this? Stuff of that nature. But let's get more in depth here. So every state has slightly different forms. Now, I'm in Arizona. In Arizona, we have a pre-qualification form that the Arizona Association of Realtors produces, and that's used in each transaction. And we have a loan status update that any party to the transaction can use to get an update on where that file is at, as far as, do you have all the documents, Mr. or Mrs. Lender? Do you have the contract? Do you have the title report? Have you ordered the appraisal? Has it come back in? Have they locked in their interest rate? All of these things that are obviously very important to the financing process, but not every state has forms like that. So you might be limited in that, just based on what your state has. And if your state doesn't have it, you might want to think about rallying of, can we get this form? Can we look at what Arizona's using? Because it really does give power to all parties involved to make sure that that buyer is progressing to where they need to be. Not to say that the loan status update is perfect in the sense of, some lenders won't fill it out properly, stuff like that. So it's not perfect, but at least it's something. So how will you know that this buyer can get approved? How are you going to know? Obviously, you're getting some sort of documentation from the lender saying that they're pre-approved for this amount. One question I would ask is, how tight is this approval in terms of their debt to income ratio? Are they just slightly off in terms of if rates were to go up, would they be in danger of not qualifying? This is definitely a question that every buyer's agent should be asking, but maybe if you're the listing agent and you've made a phone call to the lender before accepting that offer, that might be a question that you would ask is, hey, how close are we on these debt to income ratios? So how will you know if at the end they can get approved? How solid is this approval? And everybody's interpretation of how solid an approval is going to vary, but here's my interpretation of it. If they have been run through automated underwriting, whether that is desktop underwriter, commonly just called DU, which is Fannie Mae's automated underwriting system, or loan prospector called LP, which is Freddie Mac's automated underwriting system, if that file has been run through one of those, typically DU is the most common, and it's been approved, you're probably going to be okay as long as all the information that was put in there matches. So it's really going to boil down to, does that lender have all the documentation necessary for the approval that they've received in the automated underwriting, and have they looked at it? A lot of times what will happen is a lender will say, yeah, we're fine. And then they look at the documentation and they're like, oh, wait a second, I didn't know this. Just looking at that documentation, using a checklist and going over it to make sure everything is covered is just absolutely super important. So, question how solid the approval is, see how much information you can get out of them, just to make sure, at a minimum, have they, you're assuming that they've pulled the credit, got the documentation, but have they actually run it through the automated underwriting system? But I created 10 questions that you can ask. So what should you be asking? And these are kind of at a minimum. And if the lender will give more information, great. Just be aware of the whole privacy issue. It is a big issue in banking, so they're likely going to be limited on what they'll share, unless your state has some specific things that are customary that the lender is able to share. So number one, call the lender who issued the approval. So if you're the listing agent and you've got an offer, if it's being financed, I would pick up the phone and I would call that lender who issued that pre-approval to, number one, not necessarily just to find out about the buyer and what information you might be able to gather in that phone conversation, but to see if that lender is accountable. Does the lender pick up the phone? Do they return phone calls? Do they return voice messages? Do they return emails? Are they going to be somebody that you would want to work with? Because if that lender falls short, it hurts you and it hurts your seller. So I would definitely do some due diligence in that regard to make sure that this lender is actually going to communicate, because there's nothing worse than the lender just disappearing and you are not able to get any answers when you need them. So call the lender and see how receptive they are in the beginning. Number two, ask the lender if they have an automated underwriting decision. We talked about that earlier, how important that is. If they have run it through the automated underwriting system, while there is still the possibility something could happen, at least based on the information that was given as what is being used, at least that you've got a pretty good approval there versus it not being run through. If it hasn't been run through the automated underwriting, my question would be, why is this buyer looking at properties and making offers and writing contracts if they haven't even been run through automated underwriting? Now, there are cases where it's pretty simple. You see somebody has an 800 FICO score and they're putting 20% down and there's something bad and they've got they can show their income, but you never know. You have to get that documentation. The lender has to document things and make sure that they do have that automated underwriting decision. Now, are there cases where an automated underwriting decision is not necessary? There are. If somebody is manually underwritten because they perhaps have something wrong with their credit score where the computer won't approve them, and maybe there was a divorce situation and the credit scores are lower because debts that were assigned to their ex-spouse are not being paid on time, and they can document that the court assigned them to the ex-spouse. There are those possibilities. So an automated underwriting decision is not going to be required all of the time, but I would say for your conventional and government loans, you're going to see it probably at least 95% of the time. So this is a question I would ask, because if the lender starts saying, oh, well, I don't know, I'd have to check, how well have they really looked at this file? How well have they really looked at this borrower? Go with your gut instinct on that. Number 3, if it's a government loan, if it's FHA, USDA, or VA, ask the lender if they've already checked CAVRs. Now, what is CAVRs? CAVRs stands for Credit Alert Interactive Voice Response System. So CAVRs is a database, a federal database maintained by HUD that gathers information for anybody who has ever defaulted on a federally backed loan, whether that's a federally backed student loan, a past mortgage like FHA, VA, or USDA mortgage that they've had previously. It could be a small business administration loan. If the federal government had to pay out a claim on a loan that this individual had at one point in time, if that's happened within the past 3 or 4 years, it's really critical that CAVRs has been checked. This only applies to when a buyer is using FHA or VA or USDA. If they're using conventional, the lender doesn't have to check CAVRs. Now, some lenders might anyway, but generally you're not going to see that on a conventional loan, only on the 3 government programs. And so if you have a government buyer, you definitely should be asking. If you're a buyer's agent, you absolutely should know the answer to this. Have you checked CAVRs? It is as important as having had checked the credit report. It really is, because so many times I'll have somebody, one of my classes, they'll say, yeah, the loan was denied literally 2 days before the close of escrow. And I'll say, well, do you know why? And a lot of times they don't know exactly why, but when they describe it and they say, oh yeah, they said something about there was some government thing and they're not eligible for like 6 more months or 3 more months. Well, that's CAVRs. They should have checked that at the very beginning and not left it to the end. That's really important. Absolutely should have been done at the very beginning. Should have been done probably right after the credit was pulled. Now, you can kind of look at a credit report and determine whether or not CAVRs may or may not be an issue. If there's a past foreclosure on a government mortgage or a short sale, that is a huge red flag that there could be a CAVRs issue. If they defaulted on a student loan, small business administration loan, if you see that on a credit report, which you're not going to see it necessarily, but the lender's going to see it, that lender, that's the red flag right there. It's waving right in their face. Hey, check CAVRs before you do anything else, because we may have a problem. Now, if you've never heard about CAVRs, I really hope that you remember CAVRs, because if you're dealing with FHA, if you're dealing with USDA and VA, this is a super important thing. Do not get burned on that, because here's how long it takes. You go into FHA Connection. So you go into HUD portal, go into FHA Connection, and you log in, and you put in the social security number in their name. All in all, and I'm a slow typist, but you can get this done in less than 60 seconds. It doesn't take long, and I think some people can get it done in probably 30 seconds or less. So it's really simple. So to not check it, and you have to have a login and password. So it's not like just anybody can go in and do this. So generally it's the processor, not the loan officer, checking it, but they should be asking their processor to check this early on before somebody's out there looking at properties. Really, really important. So if you take one thing away from this webinar, make it this one, because on the government loans, don't get burned by CAVRs. It's there. It needs to be discovered of whether there's an issue or not. And most of the time there won't be an issue. But you know what? It's that one time when it is, and it's your file, then it's a huge issue. Protect your seller. Okay, let's talk about number 4 here. Ask the lender if they have reviewed the do not do list with the buyer. So what is the do not do list? And maybe ask the buyer's agent, hey, have you gone over the do not do list with your buyer? Do not quit your job. Do not start a new job. Do not get married between now and close of escrow. Do not apply for new credit. Do not co-sign with anybody. Do not get in a fight at work and get fired. Do not deposit a bunch of cash that you can't say where it came from. Don't spend all your money. That's huge. Like telling somebody whatever money you have in the bank right now, when you've received your initial approval, you need to have that in the bank by the end, because if the automated underwriting approval approves somebody because they have 12 months reserves of the mortgage payment, and now you get later on in the transaction and they don't have that anymore, guess what? They might be denied. I saw this recently where a guy, his loan amount, he was being denied, but he had another bank account. He had like another 40,000 that he was on jointly with one of his parents. And it wasn't being used by the lender because it wasn't necessary. It was just kind of in the file to track where a gift had come from. But he was actually on their bank statement. He was a joint account holder on that account. And so the parents had written an access letter, says, yeah, he's got access to these funds, etc. And so when he was now being denied, and the reason was because there was an undisclosed loan that came up later on, well, now he was being denied, but you add that $40,000 in assets and reserves in there, and all of a sudden that denial is an approval. So when I say that reserves, which are the assets that are going to be left over, it's the amount of money left over after somebody makes their down payment and they're paying their closing costs and all that, what amount of money they're going to have left over, those are going to be the reserves. That's money left over. Those reserves are then broken down to what is your mortgage payment and how many months reserves do you have. So if somebody has over 12 months reserves and they don't have real good credit, that's absolutely huge in how much it helps them. So whatever they are showing as their assets going into this, it needs to be the same coming out, except for, of course, what's going to be spent on earnest money deposits, appraisals, inspections, all that stuff. But otherwise, whatever they're showing as their assets, if that changes, that could cause a big problem. So the do not do list, and if you can get more in depth with the do not do list, watch the webinar on the do not do list. It goes way more in depth on that. But super important because people don't know. They don't do this every day like you do. They don't do this all the time. Remind them twice, and remind them 3 times, because I tell people things and they forget. I give it to them in writing and they forget. I give them a video and they forget. So we need to be reminding them. So you remind the lender to remind the borrower, you remind the buyer's agent to remind their buyer, and you're protecting yourself and you're protecting your seller. Okay, so let's talk about number 5. Ask if the buyer has their insurance policy in place for closing. This is generally the thing that is forgotten until the end, and you don't want that to happen. Here's the reason why. Because you never know how much that insurance policy is going to be until the policy is written. You don't know if this is going to escalate to a higher amount than they anticipated, and now it's because it's higher, it takes their mortgage payment higher for their insurance. And so now their debt to income ratio is higher, and now maybe they're not approved. That's a possibility. So you want to know that lender knows how much money it's going to require for this person to have insurance. You could have issues of past claims. Had a guy where somebody broke out the window of his vehicle and stole his cell phone or something like that, iPod, something like that. And a broken window on a vehicle isn't that expensive. You would think it's not cheap, obviously, but for the insurance company that paid out that claim, when he went to get homeowner's insurance, because at the time he was living in an apartment, his insurance was way higher than we ever expected. It could be that. It could be if they have a dog. One of the biggest claims paid out by homeowners insurance companies is dog bites. So if they have a dog, and depending on what breed, they could have higher insurance policy. I had one file where it came back and the insurance policy was about 10 times higher than we expected. We were expecting like $500 annually. It came back at like $5,000. And when I talked to the insurance company, I thought they added an extra zero, but it turns out that their teenage daughter had burnt their previous house down, or at least caught it on fire. I don't think it actually burnt down. So if you have an arsonist living in your house, you're going to have a higher insurance policy. So you can see the reason why this is so important. As a listing agent, you want to know that that's been taken care of and not put off to the very end to where it could be a surprise and cause problems and then not close at all or close late. Number 6, make sure that the property is eligible for the loan program. Now this, I'm primarily focusing on condos. If you've had a condo transaction, you know the issues with condos. If they're trying to go FHA, is it FHA approved? You can go to the FHA database, go to Google, type in FHA condo, it'll come right up. And you can look it up based on your state, county, zip code. the name of the condo, the legal name of the condo complex, I think, by city. So, I mean, you can look it up in a lot of different ways to see whether or not it's expired or not. If you go all the way to the right-hand side and you see in red it's expired, well, it's expired and it's not eligible for FHA. For VA has its own database that initially had relied on the FHA database or the HUD database, which has now had a lot of expirations. But the VA database, you can't rely on it because the lender's going to have to call VA directly and ask them if that condo complex is actually still approved for VA. And then VA will get back to them probably within 24 to 48 hours. So that needs to be confirmed. Now, when it comes to conventional, whole different story, because there's not a database saying that it's either eligible for Fannie Mae or Freddie Mac or it's ineligible. It's based on the approval of that individual. Here's an example. You could see that there was a conventional, let's say specifically Fannie Mae, there was a conventional mortgage that closed in a condo complex and it closed last month. And you say, wow, this must be fine for conventional. And so you take an offer and this person's using conventional and specifically we'll say Fannie Mae, not Freddie Mac, but it could be either or. It's just that Fannie Mae is more common. And so you say, well, it should be fine because one just closed last month. Shouldn't be an issue. But there's a difference. Let's say at the one from last month that already closed, let's say that they're putting like 25% or more down. And the person making the offer on your listing is only putting 5% down. The automated underwriting is going to be different for the person putting 20 to 25% or more down versus the person only putting 5% down, because it may not require a full condo questionnaire when you're putting a lot of money down. It may just be a limited condo review, but if you're putting only 5% down, it may want the full condo review, which is going to ask some questions that could raise issues in terms of the occupancy, in terms of the budget, in terms of litigation. All of these things that may not be an issue on a limited review could become an issue on a full review. So it's really important to understand that just because conventional closed in there once or twice previously doesn't mean it's going to work on every transaction, because somebody putting 5% down on a condo is in a much different situation than somebody putting 20 to 25% or more down. Those are two different approvals because you've got generally two different requirements in terms of what that lender has to verify about that complex. Really, really important to understand that. And this is most commonly going to be on condos. If it's a townhome or a PUD, they're going to just be treated the same as condos that you really need to be worried about. Number 7, make sure that the utilities will be on for the appraiser. There's nothing worse than finding out that the appraiser went out to get the appraisal completed, and now they have to go back out because the gas was off, the electric was off, the water was off, something like that, or that the key was pulled out of a lockbox or something of that nature. The lockbox was pulled off the house. Make sure the appraiser can get in, get the appraisal completed, that they have access to everything, that all the utilities are on, everything is ready to go. So that way they're not charging a reinspection fee, and then of course it slows down the process. So make sure everything is ready for the appraisal. Number 8, make sure that the lender has all pages to the contract. If there's been an addendum, if there's been a counteroffer, if something has changed, if there's more paperwork, just make sure that that lender has received every portion of that contract. Follow up. It's a reason to call them and touch base with them. Hey, this is the listing agent, and I just want to give you a call and say, hey, just to make sure that you have such and such addendum. I want to make sure that you knew about the change in what the seller's going to pay towards closing costs. Or I want to make sure that you knew that we want to close 10 days earlier than we originally specified. Whatever it is, just make sure that they have all the pages of the contract. Make sure they have the title report. Make sure they have everything that you can help them acquire. Ask, and it gives you the opportunity to ask, hey, how's that appraisal coming? When do you expect that back? Has it come in at value? Are we okay there? Anything that I can help you with? Offer to be helpful, because it's a great way for you to stay in contact and hopefully get them to stay on top of the file. Okay, number 9, confirm that the lender is comfortable with the close of escrow. If you're writing a contract for 15 days and that lender says, hey, we need 30 days or whatever it is, make sure they're comfortable with that, and ask them before accepting the offer and say, are you comfortable? Can you get this closed in 15 days? And some lenders can do that. Some lenders can do less than 15 days. But some lenders are not going to be able to do anything less than 30 days. So ask, find out, hey, where are we at here? Now, going back to what we talked about at the beginning, if somebody's already turned everything in and they've already been underwritten, their credit and income underwritten, and they're done on that aspect, it's just a matter of closing out verifications at the end, and you're just waiting on an appraisal and a preliminary title report, absolutely somebody could be able to close in 15 days or less. But if they haven't done that, if they haven't turned all their stuff in, a whole different story. Because if they're still waiting, there's still things out there that they may not know about this, about this borrower, in terms of if they haven't received all the documentation, they don't have a complete file, and you're still in that possible range of being surprised that nobody wants to be. Number 10, be the squeaky wheel. The squeaky wheel gets, the oil. Because nobody likes a squeaky wheel. And that's okay. I'm not saying you want people to not like you. I'm saying you want to do what's best for your client. You have a duty to your client, and you have a duty to everybody involved in the transaction to do what you can to get this to close in the most honest, ethical manner possible. So we always want to make sure that we're doing what we can, and don't just assume that something is getting taken care of. Don't trust that everything's going to be okay. Just find out. Ask, inquire. Be the squeaky wheel. Ask for updates. Call occasionally. I'm not saying call every single day. I'm saying call occasionally. Probably more than you may do right now, just to follow up, just to check in, just to make sure that everything is going as planned. And hopefully it already is. So join us next time. I hope you enjoyed this webinar. Check out the other webinars on the website. And I look forward to seeing you in the next module.